Preparing for a commercial banking relationship manager interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through how you would build a new commercial banking client relationship, from prospect to funded deal. I would start by defining the target segment and identifying a clear client need, not just pitching credit. I would research the business, ownership, industry, cash cycle, and current banking gaps. In the first meeting, they would ask diagnostic questions, then match solutions such as working capital, treasury, deposits, or equipment finance. After that, I would coordinate credit, underwriting, and implementation while staying close to the decision makers and influencers throughout onboarding. While answering, focus on targeted prospecting, understanding the client's business model, identifying needs beyond credit, coordinating internal partners, and converting trust into funded balances, deposits, and treasury opportunities. Question 2. How do you evaluate whether a commercial borrower is creditworthy? Creditworthiness starts with repayment capacity. I would analyze revenue stability, margins, EBITDA, free cash flow, leverage, fixed charge coverage, and liquidity trends. Then I would look at collateral quality, guarantor support, customer concentration, industry outlook, and management's track record. I also compare projections with historical performance to test realism. A good borrower is not only profitable, they generate predictable cash flow and communicate early when performance changes. Make sure to cover cash flow repayment capacity, leverage, liquidity, collateral, management quality, industry risk, historical performance, projections, and why a relationship manager must balance client growth with credit discipline. Question 3. How would you structure a credit facility for a company with seasonal working capital needs? For seasonal working capital, I would typically consider a revolving line of credit rather than a term loan. The line should peak when inventory or receivables build and pay down when cash is collected. I would size it using monthly cash flow needs, historical seasonality, and a borrowing base tied to eligible receivables or inventory. I would also include cleanup expectations, reporting requirements, and covenants so the bank can monitor usage and repayment behavior. In your answer, talk about matching the facility to the borrowing purpose, seasonality, operating cycle, borrowing base controls, repayment source, covenants, and why revolving credit is different from term debt. Question 4. What is more important in commercial lending, collateral or cash flow? Cash flow is the primary repayment source. Collateral is the fallback. If a borrower cannot generate enough cash to service debt, strong collateral may reduce loss severity, but it does not make the credit healthy. I would focus first on operating cash flow, debt service coverage, liquidity, and business resilience. Collateral matters for structure, advance rates, and recovery, but commercial banking relationships should be built on sustainable repayment, not liquidation value. Be sure to mention that primary repayment should come from cash flow. Collateral is a secondary source, and strong RMs understand when collateral mitigates risk, but does not fix weak fundamentals. Question 5. How do you identify treasury management opportunities within a commercial banking relationship? I look for friction in how the client moves, receives, protects, and invests cash. For example, if a business has slow collections, I would explore lockbox, remote deposit, ACH, or merchant solutions. If it has payment risk, I would discuss positive pay, dual approvals, and controlled disbursement. Treasury management is powerful because it solves daily operating problems, creates sticky deposits and fee income, and often gives the bank a broader view of client activity. While answering, focus on understanding the client's cash conversion cycle, payables, receivables, fraud risk, liquidity management, account structure, and how treasury solutions deepen relationship profitability beyond loan revenue. Question 6. How would you price a commercial loan? I would price the loan based on risk and relationship value. The starting point is cost of funds, expected loss, capital allocation, tenor, collateral, and required return. Then I would consider deposits, treasury fees, ancillary business, and wallet share. A lower rate may be justified for a strong, full relationship, but not if returns fall below hurdle. The goal is to be competitive while earning appropriate risk-adjusted return for the bank. Make sure to cover cost of funds, credit risk, collateral, tenor, relationship profitability, deposits fees, capital usage, competitive dynamics, and risk-adjusted return, rather than simply quoting the lowest rate. Question 7. What would you do if one of your clients showed signs of credit deterioration? I would act early rather than wait for a missed payment. First, I would review the financials, borrowing activity, covenant compliance, and industry conditions to understand the cause. Then I would speak with the client directly and ask for updated forecasts, liquidity plans, and management actions. Internally, I would notify credit partners, reassess the risk rating, and agree on next steps. The tone should be collaborative, but the bank's risk position must be protected. In your answer, talk about early identification, client communication, updated financial analysis, risk rating review, internal escalation, action plans, covenant monitoring, and protecting the bank without damaging the relationship. Question 8. What covenants would you consider for a middle-market commercial loan? I would choose covenants based on the borrower's key risks. Common financial covenants include maximum leverage, minimum fixed charge coverage, minimum liquidity, or minimum tangible net worth. Affirmative covenants require timely financial reporting, tax compliance, and insurance. Negative covenants may restrict additional debt, asset sales, dividends, or ownership changes. Good covenants create early warning signals and protect the bank, but they should still allow the company to operate and grow normally. Be sure to mention affirmative, negative, and financial covenants, including reporting requirements, leverage, fixed charge coverage, liquidity, debt restrictions, and why covenants should be meaningful but not overly restrictive. Question 9. Explain how a borrowing base works and why banks use it. A borrowing base ties loan availability to the value of eligible collateral, usually accounts receivable and inventory. For example, the bank may advance 80% against eligible receivables and 50% against eligible inventory, excluding aged receivables, related party balances, or obsolete stock. The borrower submits periodic certificates, and availability moves with the collateral. Banks use this structure because it aligns credit exposure with liquid working capital and provides ongoing visibility into asset quality. While answering, focus on eligible receivables and inventory, advance rates, ineligible assets, reporting cadence, collateral monitoring, and how borrowing bases connect loan availability to working capital quality. Question 10. How do you cross-sell bank products without damaging client trust? I would cross-sell by diagnosing problems, not by pushing products. If a client mentions manual reconciliations, fraud concerns, excess cash, or expansion plans, those clues guide the conversation. I would bring in Treasury, FX, merchant services, wealth, or capital markets partners only when relevant. The client should feel that each idea improves efficiency, reduces risk, or supports growth. Trust grows when product recommendations are timely, specific, and clearly tied to business needs. Make sure to cover needs-based selling, asking questions before presenting products, sequencing solutions, using internal specialists, avoiding irrelevant pitches, and measuring success through client outcomes and relationship depth. Question 11. A profitable client asks for more debt than their cash flow supports. How would you handle it? I would not simply say yes because the client is profitable. I would explain that the issue is repayment capacity, not willingness to support them. Then I would walk through the numbers, leverage, fixed charge coverage, projected cash flow, and downside cases. If the full request is too aggressive, I might suggest a smaller facility, phased funding, additional equity, stronger collateral, or a different product. The objective is to help the client grow without creating an unsustainable credit. In your answer, talk about protecting the relationship while staying disciplined, explaining repayment capacity, exploring alternative structures, phased funding, equity support, collateral, or non-credit solutions. Question 12. What metrics would you track to manage a commercial banking portfolio? I would track the portfolio from both a growth and risk perspective. On growth, I would monitor loan balances, deposits, treasury revenue, fee income, pipeline conversion, and share of wallet. On risk, I would watch past dues, covenant breaches, borrowing base availability, risk rating migration, criticized assets, upcoming maturities, and industry concentration. A strong RM knows the portfolio's profitability, but also where stress could emerge before it becomes a loss. Be sure to mention both revenue and risk metrics, including loan balances, deposit balances, fee income, pipeline, wallet share, delinquencies, covenant exceptions, risk ratings, renewals, and concentration exposure. Question 13. How would you prepare for a first meeting with a CFO or business owner? Before the meeting, I would research the company's business model, ownership, industry trends, competitors, and any public information available. I would think through likely pain points, working capital, expansion, equipment purchases, payment efficiency, fraud prevention, or excess cash. My goal in the meeting would be to ask better questions than the incumbent bank. I want to understand what the CFO is trying to achieve, where the current bank falls short, and what would create real value. While answering, focus on researching the company, industry, ownership, competitors, likely financing needs, cash management issues, recent news, and preparing thoughtful questions instead of arriving with a generic pitch. Question 14. How do the responsibilities of a relationship manager differ from those of a credit analyst? The relationship manager owns the client relationship and is accountable for growth, retention, and overall relationship profitability. That includes prospecting, understanding needs, coordinating product partners, negotiating terms, and managing communication. The credit analyst focuses more deeply on underwriting, financial spreads, cash flow analysis, risk assessment, collateral review, and credit memo support. The best outcomes happen when both roles challenge each other constructively, because the RM brings client context and the analyst brings independent credit discipline. Make sure to distinguish client ownership, revenue generation, portfolio strategy, prospecting, and internal coordination from detailed underwriting, spreading financials, credit memo preparation, and independent risk assessment. Question 15. Tell me about a time you had to balance client advocacy with the bank's risk standards. I would frame the answer around judgment, not just conflict resolution. In a real situation, I would first understand what the client needed and why, then test that request against credit policy, financial capacity, and risk appetite. If the original ask did not work, I would present alternatives instead of hiding behind policy. I would communicate clearly with the client and credit team, document the rationale, and aim for a solution that preserved trust without weakening standards. In your answer, use a clear behavioral structure, describe the business tension, show how you communicated with both sides, and emphasize judgment, transparency, documentation, and long-term relationship thinking. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.